announced. Now, yesterday we saw the local market drop 1.5% on fears about China's efforts to curb property speculation. But today the ASX200 index bounced back. So where did all the fears go? Let's get more with the eternal market bull, Clifford Bennett, the chief economist at White Crane Group, who's also tipping that the Dow will hit 20,000 in this rally. Welcome, Clifford.
Thank you for having me on your show, Peter.
My pleasure, mate. Now, do you want to correct me? You're not really an eternal bull. You've just been a bull since March 2009.
That's right. Just these short-term swings we're trying to capture. Peter, yesterday's fear is like a snowflake in summer. Basically, fear is lost. We're not yet in the period of greed, but we're certainly into the period of curiosity about becoming greedy again. So bad news, and really the Chinese data wasn't bad news. A 54.5 for services PMI in China is still a services PMI that plenty of countries around the world would love to have. The other thing is the Chinese looking to dampen property speculation. That's a positive as well.
Yeah.
So the market really had a knee-jerk misinterpretation of events yesterday, and obviously in New York they didn't fall for that and they just powered on.
Yeah, because in many ways, Clifford, it's logical that there would be companies heavily exposed to the Chinese property market. When the rules change, those companies are going to be finding difficulties in the market. That's why Shanghai Composite was down 4%. But you're right. In New York, they didn't care, and like you, they probably think, well, better that the air be taken out of the bubble rather just slowly, rather than a big pin being put into it and the whole thing blowing up.
Well, it's actually careful, cautious and appropriate economic management to avoid the sort of asset bubbles that we in the West have become used to. With regard to Wall Street and the price action we're seeing, I really do think right here, right now, around 14,100 to 14,250, this is a major long-term inflection point, if you like. Once we start to get through 14,200, you're going to have a very fast run to 14,700 in the short term. 15,700 this year, probably quite quickly in a matter of months. And then we're looking we haven't changed our forecast for the Dow Jones hit 20,000 in about 2016 for about 2 years. So that we've had that sort of 4 to 5 year view for some time.
So is your view then that the Dow heads to 20,000 across the time period to 2016, and then you'd expect the market collapse?
I'm not sure about that, Peter. It might go higher. I'm just picking that we get there first. And of course, there'll be some pullbacks along the way. There'll be periods that are good-sized medium-term bear trends, if you like. But the long-term trend is definitely up. And really, the dominant risk at the moment for everyone in the market is that you simply don't have enough stocks.
Okay. Now, so you have had your critics in the past, and the critics have often come at you when the market has gone down. But generally, by the end of the year, you got a big smile on your face. Is this the kind of thing you're going to expect this year?
Well, I hope so, Peter. It's nice to have a smile on one's face.
But we'd be bagged in the middle of the year.
Yeah, that's right. That tends to be the pattern for me. But I did say on your last show of the year last year, when you asked for forecasts, that 5,200 was a minimum target this year. 5,700 was the potential target. And it's looking more and more like we will get to that 5,700 along the way.
Okay.
I mean, Australia has its own problems. Australia has serious problems pre-election. But post-election, I think the Australian economy and the share market will have a major run to surpass what we're seeing at the moment. So that could easily kick it up at the end of the year.
Okay. I'm not sure if you're aware of these statistics, but Sam Stovall of S&P wrote overnight that when the S&P 500 hits its all-time high, it tends to go about, the median gains about 3% before it sells off pretty drastically. Is this something you're aware of?
Peter, you always have good news for me. I mean, S&P, great reverse indicators. If they're cautioning a high, I'm just going to leverage up some more on the longs.
Yeah.
And given that their track record over the last several years is 53% wrong on bond calls, even when they're downgrading countries and companies. But that aside, I think you've never had a move to new highs before when the market was only 3 to 6 months ago very bearish in sentiment. You've never had a move to new historical highs when the market commentariat, if you like, didn't believe it could happen. So this is a situation where we're just hitting new highs and people are still short. We're going to have a period of panic buying where major global funds have to chisel in and angle in against each other. Otherwise, they're going to end up bottom of quartile performance outcomes at the end of the year. So if people in the major funds want to keep their jobs, they're going to have to buy pretty aggressively and very soon. So everyone's been hoping for a pullback. It hasn't happened. They're going to have to start to chase the market higher.
Yeah, so the summary is this time it's different.
Are very different, complete different historic. You know, everyone was bearish the global economy. Now they realise they were wrong. They have to turn bullish, as we've been. People thought the market was a bear market and was going to come off. It hasn't. They're going to have to turn around. No one, hardly anyone in the world is positioned for a grand bull market, which we've been in for a couple of years and has several years to run. No one's positioned for it. We're at new highs. There's no sellers left. The market's going to run hard.
Okay, the RBA's decision today. Come on, Clifford, surprise us. What's your view?
The Reserve Bank of Australia again got it wrong today. You know, they were responsible for putting the domestic economy in reverse gear. They're talking about the global scenario improving. Been forecasting that for months, of course it is, but that's not Australia's problem. Australia's problem is the domestic economy is only running at 1.3, 1.5%. If it wasn't for the miners, we might even be in negative GDP. So thank goodness for the miners, but the only part of the economy the Reserve Bank has any influence over is the domestic economy. The domestic economy is in trouble. Retail sales today up 0.9. That means over the last 4 months, the net total of growth in retail sales is 0.2%. Annualised, that's 0.6%. These are bad numbers. Housing approvals yesterday down. Corporate profits down 1% in the fourth quarter. The only thing that will support fourth quarter GDP number will be public spending. That's not what we want. We want the private sector being supported and encouraged. That's not happening.
What about the Capex figures, which are all based on positive plans?
Well, look, the resources boom is not over. It was never over. I said that all the way through last year. China's imported more iron ore and coal from Australia every single month, month after month. No end to the resources boom. So I'm not sure what the minister was talking about when he said it was over. But the resources boom is ongoing. Capex is going to be ongoing. Capex is going to be a large number. But again, it's Australia being rescued by China running its economy well, not us running our economy well. It's Australia being rescued by China requiring more of our resources and us riding that gravy train, if you like. But when it comes to what are we doing in Australia to manage our economy well, we're the great underperformer of Asia, and there's no way of getting around that.
All right, Clifford, thanks for joining us, mate, and we'll
Thanks,
hope
Peter.
you're right on the 20,000 call.
Thank you.